So the pitch is lower monthly payments because you're spreading that principal over 600 payments instead of 360. Okay, so what's the reality check for that? The reality check for that is to make it worth it for lenders and investors to want to loan you money for such a long time, 50 years, to make their money back. It basically, the interest rate has to be high. It has to be higher than that of a 30-year. So extra spread, so possibly anywhere from, 0.5%, 0.75% more than what it would be if it was the 30-year. And yeah, that might, in principle, that does lower your monthly payment, which means that you can afford a little bit more because for the same monthly payment, maybe we can add another 50K, 70K to your loans. Given how much your equity growth slows, because when you make mortgage payments, in this case with a 50-year loan, there's 600 mortgage payments, right? And what it is at the beginning of your mortgage payment process, you're actually paying back very little equity and you're paying back more towards interest. And then over time, that sort of shifts and inverts. And at the end of your loan, you're paying mostly towards equity and less towards interest. That's just how amortization goes, right? So if you stretch that out to 50 years, you have to imagine just how little of your payment for the first few years is going to be towards equity, which means it's very hard to build equity in your home because so much of your mortgage payment is going towards the interest.